So now we're going to take a look at identifying 4 required financial statements and how to prepare 3 of these. So first of all, financial statements formatting standards. All financial statements, they're going to have to follow certain formatting standards. So each statement is going to have 3 lines at the top that are going to identify the name of the company. And again, in this case, we're going to use ACE bookkeepers. And the statement, depending on what it is, the balance sheet, income statement, whatever. But in this case, we'll look at the income statement and the time period of that statement covers. And so in this example, it would be for the month ending on March the 31st of 2023. Now, the first number in each column is going to have a dollar sign in order to indicate the currency of values that are represented by the statement. And this is important because you might have a company that is a multinational corporation that might have operations in more than one country. And so they might be reporting operations in one country in one currency and in another country operations in another currency. For example, the Aflac insurance company, you know them, they're the ones that have the duck. They, believe it or not, are really huge in Japan. Well, Japan, they use the yen, whereas in the US, of course, use the US dollar. And so being aware of that is important. So in our case, it would include a dollar sign to indicate the currency. The last number in a calculated column is going to have a single underline in order to indicate that it's a total or a subtotal. And then the final number on the financial statement is going to have a dollar sign and is going to be double underlined. And in the case of the balance sheet, this indicates that the total assets and the total liabilities plus owner's equity figures are in balance. Okay. So the 4 statements that we look at, and they would have to be prepared in this order because you're going to use information from the previous statement. You're going to have that and have figures from that in order to go into the next one. So they have to be done in this order. So we have our income statement. We would then have a statement of owner's equity. And the information from both of those then are going into our balance sheet. And then we also have what's called a statement of cash flows. So the income statement is where we report the revenue that's earned and the expenses that are incurred during the period. And so in our example for ACE bookkeepers, this income statement is for the month that ended March the 31st of 2023, and it would show a net income of $9,400. So we see there we have our heading that lists the name of the company, it lists which statement, lists the time period. Then we list out our revenues. In this case, it's a service business, so we have service revenue. Then we list out expenses, all of our expenses. We subtract the total of the expenses from the revenue, and we get what our net income is. Our net income is the bottom line, and that is our profit or loss for that particular period. In this case, they had a profit because the revenue was greater than their expenses. So they did well for the month. Now that we have our income statement, then we can then go ahead and create our statement of owner's equity, which is what shows the owner's equity that it was how it changed during the time period. The closing balance for March would then become the opening balance in April on April's statement of owner's equity. So we see again the same heading. This time it's the statement of owner's equity. And John Smith was the owner of the company. He did not have any equity in the business in March, at the beginning of March, because this was started during the month of March. And then you would add his investment. So he invested $30,000, and then we would add the net income from the income statement, which is $9,400. And then we would have to subtract what he took out, which he took out $2,000. So we'd subtract that. And so then he has 37,400 in equity ending for the month of March. And then that's where we're going to start then in April, and then just repeat. So then we'll take a look at his balance sheet. So after we've prepared our statement of owner's equity, we can then go ahead and create our balance sheet that reports the balances of all of our assets, all of our liabilities, and all of our owner's equity. The value of the owner's capital is going to be taken from the statement of owner's equity. Also, the total of assets is going to be equal to has to be equal to the total of our liabilities and our owner's equity. So we see that. So we have here all of his assets listed, 48,400. We have his liabilities, and so he owes accounts payable. He has unearned revenue, and then also a note outstanding, 11,000. And if we take that and the amount of owners of capital that he has, if we add that up, we have total liabilities and owner's equity of 48,400, and that has to equal the assets, which is 48,400. What happens if something, let's say that doesn't balance out, then we have to go back and look and see where did we make a mistake along the line somewhere. All right, so sequence of assets and liabilities on the balance sheet. The assets on the balance sheet are going to be listed in sequence according to their liquidity. And liquidity is the ease with which an asset is able to be converted into cash. So cash would, of course, be the most liquid asset. And so it would be then, of course, be listed first on the balance sheet, followed by accounts receivable, inventory, and so on. Property, plant, and equipment, such as buildings and machinery, would be the least liquid, and then so those items would be listed last. Liabilities are listed in a similar manner, and so those that would be payable within the shortest amount of time, which would usually be due within 1 year, would be listed first. Debts that will last longer, such as long-term bank loans, are listed last. And then from that, we're able to then go ahead and create our statement of cash flows, which shows the cash inflows and outflows from operating, investing, and financing activities. And we see it broken down. Again, we have the same type of heading, and then we have a section for operating activities, a section for investing activities, and then financing activities listed there. Then we have the beginning cash balance, and then we have our ending cash balance. Okay, so which of the following information is not included in those 3 lines at the top of a company's financial statement? So the company's name, the statement name, the company's industry sector, or the time period. And it would be the industry sector, but all the other things there are going to be listed. Now, which of the following listing of liabilities is in the correct order? And remember, it's going to be what gets paid first to what gets paid latest. And so in this case, accounts payable, those are usually paid within 30 days. Notes payable, those would be written promissory notes, those would be paid out later. And then a mortgage could go for 15, 20, 30 years. So those would be listed in that order.